So moving forward into the current macro environment, uh, I'm not sure how many of you were originally on our March 2024 webinar, but it's a bit of an update on what we'd seen in that environment. Um, so as at December 2024, we're currently settling into what we think is the aftermath of one of the most significant moves in interest rates in modern history, with the Reserve Bank of Australia increasing the cash rate from 10 basis points to 4.35%. Offshore moves were even more substantial than that, and particularly more rapid, specifically in the US and in Europe. And the impact of those rate increases was acutely felt in Australia due to the structure of our housing and mortgage market. So about a third of our population tend to be mortgage holders, and the transmission of rate increases in our part of the world is particularly swift. Unlike in the US, where fixed rate mortgages can be up to 30 years long, Australian borrowers typically fix their mortgages, when they do fix them, for a maximum of 5 years, with most people opting for about a 3-year term. Currently, the ABS reports that about 98.8% of all new home loans are being written on floating rates, which is slightly up from earlier in the year. This definitely reflects to us growing expectations around the population that we're at the peak of the interest rate cycle, or we're very close to it. For a floating rate mortgage holder who was paying 2% 2 years ago, their current rate now is somewhere north of 6%, which means that their repayments are approximately 3 times higher, putting significant pressure on them. While that third of the population has a mortgage, another third, the other third of the population that we talk about, tends to own their house outright, while the final third is in the renting category. The people that own their homes outright will benefit from the higher interest rates through increased returns on savings. Despite all of that, the 2/3 where people are renting and paying mortgages, you're finding that those consumers are under significant pressure. Retail sales in Australia have remained under pressure throughout 2024 as a result of that. And after adjusting for inflation, you've seen that they've been consistently negative for much of this period. The most recent data for November showed that retail sales growth was about 0.2%, which was a slight improvement from the negative 0.1 in the month before that. So 0.2 is still, in real terms, very weak. Discretionary spending remains the most impacted category that we can see as consumers adjust their budgets to manage high mortgage repayments and living costs. And while everyday essentials have shown some nominal growth, this is predominantly attributed to ongoing price increases rather than an increase in volume. The Australian consumer, we think, remains under strain heading into 2025, with little relief expected until we either see the RBA move on an interest rate cut, or we see wage growth accelerating significantly. We are seeing some levels of wage growth in certain areas, but not across the board. While we've consistently been saying that we only expect the RBA to commence their cutting cycle in May next year, we've already seen the US, Canada, Europe, and our neighbours in New Zealand start their cutting cycles.